Traditional finance assumes that markets are efficient. This means that according to traditional finance, any new information is incorporated into security prices. So at any point in time, a security price is what it should be. Therefore, the returns that we can expect on securities will be a normal expected return. According to the efficient market hypothesis, we should not get any abnormal returns on securities. But we know for a fact that this is not always true. There are market anomalies which can be observed. So therefore, a more appropriate statement would be that markets are generally efficient, but behavioral biases can lead to market anomalies. So in this section, we will define what is meant by market anomalies, and then we will look at three major anomalies: momentum, bubbles and crashes, and then value. So let's start by defining market anomalies. An anomaly is an apparent deviation from the efficient market hypothesis. So as I said, with efficient market hypothesis, the assumption is that all available information is incorporated into security prices, and therefore abnormal profits will not be possible. However, we have observed that at times abnormal profits do exist. So how can we explain various anomalies? On this slide, we will talk about some explanations without considering behavioral finance, and then on subsequent slides, we can talk about how certain anomalies can be explained using behavioral finance. So one possible explanation for observed anomalies is the shortcoming of the underlying asset pricing model. So we have a simple asset pricing model such as CAPM, the capital asset pricing model. There is no guarantee that this is a perfect model. Therefore, if a mispricing exists because we are using CAPM, then that is a limitation of CAPM, and this does not mean that the anomaly actually exists. Another possible reason for anomalies is that our sample size is too small. We can have statistical biases. So for example, we can have survivorship bias, where we are only selecting or working with companies that have survived, and we ignore companies that have gone out of business. We talk about survivorship bias in more detail in other parts of the curriculum. We can have data mining bias, where we over-analyze data for patterns, and we also then treat spurious correlations as relevant. There might also be a temporary disequilibrium behavior. This means that some unusual features may survive for a few years, but then ultimately disappear. So these are some explanations outside of behavioral finance. Now let's talk about how behavioral finance can be used to explain certain commonly observed anomalies. One common anomaly is the momentum or trending effect, and here future price behavior correlates with recent past behavior. And we see this often. Let's say there is a given stock that has gone up recently. Generally, the momentum effect or trending effect says that if a stock is going up, chances are that it will continue to go up. This is a violation of the efficient market hypothesis, because according to the efficient market hypothesis, the price at a given point in time fully incorporates all information. So just because there is an upward momentum, according to efficient market hypothesis, we should not be able to say that the future price will also be going up just because of what happened in the past. But the observation is that generally this momentum does hold. In the short term, the correlation is positive. So if a stock has been going up, then chances are that the momentum will keep taking it up. And this applies not just to stocks, it also applies to markets. In the long term, however, the price will come down. Why? Because if this is going up purely because of momentum, obviously the stock or the market will tend to become overpriced, and then there will be a correction. So in the long term, there is a negative correlation. Now let's look at some biases that might explain the momentum or trending effect. One bias is the availability bias. According to this bias, we estimate probabilities based on how easily events come to mind. So events that come to mind more easily get higher probabilities. And we can see how that connects with the recency effect. If a stock or the market has been doing well recently, then this is what comes to mind. So in our models and in our projections, we give a greater weightage to the recent performance because this comes to mind more easily. And then if we are projecting based on this more recent information, then chances are that our models will also say that the stock price or the market price will continue to go up. Another way of putting this is that the availability bias or the recency bias will get us to put greater emphasis on the small sample size, which is the most recent performance. Or if the market has been performing poorly in the recent past, then we give this more weightage and predict that in the future the market or the stock will continue to go down. Another bias which might explain the momentum or trending effect is the hindsight bias. Now, regret is an expression of hindsight bias. And what do I mean by that? Let's say that we invest in stocks and mutual funds, and in the last year, a certain mutual fund performed very well, but we did not invest in this mutual fund. We believe, however, that this was because of some incorrect analysis that we had done, and we evaluate this in hindsight and say that we should have bought this mutual fund. So we feel regret because we did not buy this mutual fund that performed well. So that's what I mean when I say that regret is an expression of hindsight bias. So we are sitting here, we are feeling regret, and to make up for that regret, we now buy this fund. So it performed well last year, and because of this regret, we don't want to be in a situation where this continues to perform well and we miss out on the good performance. So we buy the mutual fund that's doing well. And then that again reinforces the trend. So essentially, we are chasing the trend. If the trend is positive, we will buy. And the opposite is also true. If we purchased a fund that went down, so here we will feel regret because we say to ourselves that we should never have bought this fund. So what we will do here is sell. And so essentially what is happening here is a trend chasing effect. So keep in mind now the two biases that help explain this particular anomaly are availability bias, which is linked with the recency effect, and hindsight bias, which is related to regret and trend chasing. Another market anomaly is bubbles and crashes. Bubbles and crashes can be defined as periods of unusual positive and negative asset returns. Two classic examples are the technology bubble of 1999-2000 and then the residential property boom of 2005 through 2007. So in the late 90s, the technology stocks in the US did extremely well. So in just a few years, technology stocks went up a lot. But then in 2000, the technology stocks crashed very quickly. So this was an example of a bubble. So the technology bubble or the dot-com bubble. And then this crashed in a matter of weeks. In 2005, the property market in the US started going up. So between 2005 to 2007, the property market did extremely well. Property values, real estate values went up. But then in 2007, the value came down sharply. So this also was an example of a bubble. So we can say that this was the real estate bubble, and then it was followed by a bust or a crash. Now, behavioral finance can be used to some extent to explain bubbles and crashes. This can be, obviously there are many explanations, but here we are talking about behavioral finance. So let's look at some of the biases that we've discussed and then relate them to this particular anomaly. Overconfidence. So overconfidence is where investors have a strong belief or they are overconfident about their own knowledge or their own skills. And as a market starts doing well, investors who have purchased certain stocks become confident. They think that it's their own skills that have resulted in these gains, and then they end up buying more. So the market goes up even further. Self-attribution is related to overconfidence because the success or the increase in value that they are seeing, they attribute to themselves. And again, that encourages investors to just buy more. Confirmation bias is linked because investors will only look at research and articles and information that confirms their beliefs. And at this time, they tend to ignore negative information. They tend to ignore information that might suggest that markets and stocks are overvalued. Regret aversion also plays a role during the bubble phase or the boom phase because investors who have not benefited from returns in the past during this boom period might purchase stocks or might make investments so that they don't have regret. And the other aspect is that with the markets going up, those who already own these assets that have done well want to continue to own these assets because they don't want to face the regret that they missed this boom market. So regret aversion also plays a role in the formation of the bubble. As the bubble unwinds, there can be underreaction that can be caused by anchoring when investors do not update their beliefs sufficiently. There can be cognitive dissonance where investors ignore losses, attempting to rationalize flawed decisions as this bubble unwinds, and investors may initially be unwilling to accept losses. We can also have the disposition effect. This leads investors to hold on to losers and postpone regret. This in turn leads to an initial underreaction to bad news, but later causes capitulation and acceleration of share price decline, which effectively leads to the crash. So this explains why the crashes seem to be much more abrupt and much faster than the bubbles. So as I mentioned earlier, the bubbles take a little longer to form, but crashes tend to happen in a much shorter period of time. In this final section, we will look at the return on value stocks versus growth stocks. Several studies have shown that value stocks have outperformed growth stocks over long periods. We see this in other parts of the curriculum, but very briefly, value stocks are those stocks that have a relatively low price to earnings ratio, low price to dividend ratio, but a high book value to market value ratio. So the point is that value stocks are those stocks that are relatively cheap compared to earnings or dividends. And studies have shown that these tend to outperform growth stocks. Growth stocks have the opposite characteristics. So growth stocks will have a high PE, for example. One way of dealing with this issue has been presented by Fema and French, who extend CAPM to say that size and value are also risk factors. And when they incorporate size and value as risk factors, then this particular anomaly seems to go away. But in addition to this way of dealing with the problem, we can also look at some behavioral aspects. One behavioral aspect is covered by the halo effect. So the halo, as you know, is something that we put on a very noble person. And the context here is that if a certain type of company is respected, so let's say that generally investors respect companies where the share price has done well, where there is consistent growth. So these companies tend to get a halo effect in the sense that investors like these companies. And this generally happens with growth companies, because what I just described is the growth has happened, share price is going up. So because of the halo effect, the risk associated with growth companies might tend to be underestimated. And if risk is underestimated, then in the long run, there is an issue. In the long run, these companies might not do as well as value companies. Also related to growth companies is the overconfidence effect. If a company has been doing well for some time and those who are analyzing these companies are overconfident in their ability to analyze, and they will also then underestimate the risk associated with growth company. Emotions also play a role in estimating risk and expected return of stocks. An emotional rating in a company leads investors to perceive that the company's stock is relatively less risky. Although the capital asset pricing model assumes risk and expected return are positively correlated, many investors behave as if the correlation is negative, expecting higher returns with lower risk. The emotional attraction of stocks can be enhanced by personal experience of products, the brand's value, and the proximity of the head offices to the analyst or investor. So if the head office is nearby or in the same country, then we say that there is a home bias. And this home bias anomaly will lead to a relatively higher price or higher value for companies that are classified as home companies or stocks that are classified as domestic stocks. We are done with all the sections of this reading. Now let's summarize the main points. We started out by talking about cognitive errors. And remember, with cognitive errors, we have two broad categories. We have belief perseverance biases and then information processing biases. Under belief perseverance, we talked about conservatism, confirmation, hindsight, illusion of control, and representativeness. And then under information processing, we talked about framing, anchoring and adjustment, mental accounting, and availability. Talked about emotional biases, and the emotional biases were loss aversion, overconfidence, self-control, endowment, regret aversion, and status quo. So you need to be able to say a little bit about each of these biases and recognize which category they are in. We also said that cognitive biases are relatively easier to address compared to emotional biases. And then in the last part of this reading, we talked about how these different behavioral biases influence market behavior. So there are several anomalies that can be observed, and these anomalies can be partially explained using the types of biases that we've discussed in this reading. So that is it. As always, I want you to do as much practice as possible. Go through the examples in this reading, do the practice problems at the end of the reading, and also work through the IFT question bank. That is it. Best of luck.